In this video, I want to continue talking about adjusting entries. And specifically, I want to talk about accrued revenues. This is when the business has earned revenue, but they haven't collected the cash from the customer yet. And the reason why this might come up as an adjusting entry instead of just a regular everyday entry is because there might be some jobs at year end that the company has partially completed. In other words, they may have partially performed the services for that particular customer, or they might have given the customer a partial order of goods, and maybe they just don't have the documentation in the system yet. So they would want to go ahead and record any revenue that they've earned up to year end. So the easiest way for me to explain this is just to give you an example. So let's use an example of a company being hired in December for performing some services for a client that's going to take a couple of months. Maybe they're going to be working on this in December, January, and maybe even into February. And let's say the total job is going to be a $10,000 job. So they start performing services. So maybe they haven't received any revenue yet, but they start doing the work in December. Well, if year end happens at the end of December, they might look at this job and ask themselves if they've earned any of the revenue so far. So at year end, assuming year end is December 31st, they would want to look at this to decide how much of the revenue they've earned up to that point, from the time they started the job to the time that they're doing their year-end adjusting entries. So let's say at year-end, they calculate or estimate that they've earned 30% of the revenue. What they would want to do is record 30% of the $10,000. So 30% of $10,000 is $3,000. So your adjusting entry would be for the $3,000. And you would simply debit accounts receivable and credit service revenue. So this is probably one of the easier categories of adjusting entries because all you're doing is looking at what they've earned and recording a receivable and a revenue. So I assume that this happened in 2025, and what would happen when they collect cash in 2026, or whatever year they collect the cash in, they would factor in the fact that they've already recorded $3,000 of revenue. So they wouldn't want to record that twice. And I'm kind of out of space here, so I'm going to try to squeeze an entry over here on the left. Okay, so let's say in February of 2026, they received the cash. So you would debit cash for $10,000. You would credit accounts receivable because you would want to zero out this $3,000 in receivables since the customer is now paying. So you would credit accounts receivable for $3,000. And then you've already recorded $3,000 of the revenue in 2025. So in 2026, you would want to record the other $7,000 of revenue. And this is the adjusting entry. So that's it. That's all you have to do. You're simply taking the total revenue that they're earning and you're dividing it up into 2 different years based on when they perform the services. And that's all I wanted to cover in this video. If you have any questions, feel free to comment below, and thank you for watching.